In the modern global economy, debt has become both a lifeline and a burden for many African nations. Loans from international lenders, bilateral agreements, and bond markets provide financing for infrastructure, education, and healthcare. But these debts are not without consequence. They must be repaid, often in hard foreign currencies like the US dollar or the euro. And this is where a dangerous idea sometimes emerges: the belief that governments can simply print more of their own currency to pay back what they owe. On the surface, it might appear logical. After all, if a country controls its central bank, why not use the printing press to generate the money required? But beneath that seemingly simple solution lies a trap, one that history has shown to be devastating for nations that have attempted it. Inflation, devaluation, and economic collapse are the almost inevitable outcomes. In this documentary, we will explore why printing local money cannot solve Africa's debt problem. We will examine the technical and economic limitations, the consequences of such actions, and real-world examples from around the globe. We will also highlight what alternative strategies might exist for African economies to escape the debt cycle without falling into financial ruin. Most African countries borrow not in their local currency, but in foreign currencies. When Ghana issues Eurobonds or Kenya takes loans from the International Monetary Fund, those obligations are denominated in dollars or euros. This is because international lenders demand repayment in stable, globally accepted currencies. Imagine a simple analogy. A household in Nigeria might borrow money from a relative in London. That relative will not accept repayment in Nigerian naira. They want pounds or dollars. For the Nigerian household, printing more naira does not solve the problem. It only worsens it, because the naira must be exchanged for pounds at whatever the current exchange rate is. And herein lies the core issue. Printing more local money increases its supply without increasing its underlying value. On the international market, this floods the system with currency that fewer and fewer people want. The result is depreciation. $1 suddenly costs more naira, more shillings, or more cedis. The very act of trying to repay debt makes the debt more expensive. This dynamic traps governments in a cycle. They need foreign currency to repay debt. They print local money to buy it. The exchange rate collapses, imports become more expensive, inflation rises, and the government finds itself even further from its goal than before. Let us take a closer look at the consequences. 1. Inflation and hyperinflation. When a government prints more local money, it increases the total money supply. But the goods and services available in the economy do not instantly increase. The result is more money chasing the same goods, which pushes prices higher. At first, this may be manageable. Prices rise slightly. But as the cycle accelerates, inflation can spiral out of control. If citizens lose faith in the currency, they rush to spend it quickly, fearing it will lose value tomorrow. Businesses raise prices daily. Salaries cannot keep up. And eventually, the system collapses into hyperinflation, where money becomes almost worthless. 2. Currency devaluation. On international markets, investors and traders watch carefully. If a country prints aggressively, demand for its currency falls. Nobody wants to hold a depreciating asset. The value of the currency plummets. This means that every dollar of foreign debt now requires exponentially more local currency to repay. What began as a debt problem now becomes a full-blown currency crisis. 3. Import costs skyrocket. Most African economies depend heavily on imports: fuel, machinery, medicines, food staples like rice and wheat. As the local currency weakens, the cost of these imports rises sharply. A bag of wheat that once cost 100 local units may suddenly cost 200 or 300. Ordinary citizens feel the pain directly in the form of higher food prices and increased cost of living. 4. Loss of confidence. Perhaps the most devastating effect is the loss of trust. International lenders, domestic investors, and even ordinary citizens lose faith in the currency and in government policy. Investors pull out their money. Citizens try to hold wealth in dollars, euros, or gold instead of local cash. Black markets for foreign currency emerge, and the government finds itself increasingly isolated. 5. Restricted access to future credit. Once a country is perceived as fiscally irresponsible, international lenders become far more cautious. Future borrowing becomes limited or comes with extremely harsh conditions. In some cases, sanctions or restrictions can even be imposed, leaving the government unable to finance essential public services. Technical limitations. The situation is made worse by technical realities. Unlike the United States or Japan, countries that borrow in their own currency, African governments do not enjoy the exorbitant privilege of being able to print globally accepted money. The Nigerian naira, the Ethiopian birr, or the Zambian kwacha are not reserve currencies. When Zimbabwe printed money during the 2000s, it could not use that currency to repay IMF loans or foreign bonds. Those debts had to be serviced in dollars, so the Zimbabwean government had no choice but to attempt exchanging its hyperinflated local currency into foreign currency. The result was predictable: total collapse. Simply put, printing is not a tool for foreign repayment. It is at best a domestic financing measure, and at worst, a path to destruction. Historical examples. 1. Zimbabwe. Perhaps the most infamous example comes from Zimbabwe. In the late 1990s and early 2000s, the government faced mounting expenses and a shrinking economy. Instead of cutting spending or restructuring debt, it printed more money. The outcome was catastrophic. At its peak, Zimbabwe experienced inflation rates exceeding 200 million%. Citizens carried bags of cash just to buy bread. Eventually, the local dollar became worthless, and the country was forced to abandon it altogether, adopting foreign currencies instead. Argentina, though wealthier and more industrialized than many African nations, has also suffered repeated debt crises linked to currency mismanagement and printing. Each time the government resorted to the printing press, the peso collapsed, inflation surged, and international trust eroded. The nation has defaulted on its debt multiple times, trapping it in a vicious cycle of borrowing, crisis, and default. Turkey. Even Turkey, a middle-income nation with a diverse economy, has faced dramatic currency depreciation in recent years, partly due to monetary policies that undermined confidence. Although not as extreme as Zimbabwe, the Turkish lira's decline shows how quickly investor sentiment can punish governments that lose credibility. These stories carry lessons for Africa. Printing money is not a shortcut. It is a direct route to instability. Despite overwhelming evidence, the temptation to print money remains. Political pressures, social unrest, and urgent needs can push governments to look for quick fixes. Printing appears to offer instant relief. Teachers can be paid, infrastructure can be built, subsidies can be funded. But the relief is temporary, while the damage is lasting. Printing treats the symptom, not the disease. And in many African nations, the disease is structural: overdependence on commodity exports, weak tax systems, corruption, and poor integration into global value chains. Without solving these deeper problems, printing will never provide a sustainable solution. Alternatives to printing. If printing money cannot solve Africa's debt problem, what can? Economists suggest several alternatives: debt restructuring, negotiating with creditors to extend repayment deadlines, lower interest rates, or even forgive part of the debt. This has been done before, notably under the Heavily Indebted Poor Countries Initiative. Diversification of economies, moving away from dependence on a few commodities toward broader industries such as manufacturing, technology, and services. Regional cooperation, strengthening African trade through initiatives like the African Continental Free Trade Area, reducing reliance on external borrowing. Improved tax collection. Many African nations collect less than 20% of GDP in tax revenue. Closing loopholes, reducing corruption, and expanding the tax base can provide governments with more reliable income. Attracting investment. Instead of printing, governments can create conditions that attract foreign direct investment, improving infrastructure, governance, and stability. Prudent monetary policy. By maintaining stable inflation and protecting central bank independence, African nations can build trust and resilience over the long term. The idea of printing money to pay foreign debt may appear simple, even seductive, but history, economics, and experience all prove otherwise. For African nations, such a move would bring inflation, currency collapse, loss of trust, and deeper poverty. The printing press cannot create real value. It cannot generate foreign currency. It cannot substitute for sound economic management. If Africa is to break free from the cycle of debt, the answer will not come from the printing press, but from reforms, cooperation, and investment in long-term growth. Because money, at its core, is not paper. It is trust. And once trust is lost, it is nearly impossible to recover.